if it starts to run from here, as I suspect it will, JPMorgan is going to be printing money forever, profits on gold and silver. So will they go short again is the big question and stop the price. I mean, I've said no in the past, admittedly, and they've come back and gone short. Therefore, they may do it again, but they've never been positioned like they are right now. They have more physical silver and gold than they ever had. They have no short position. I say one of these days they're going to stand aside and just let this thing go, and I can't see any better day than right now. JPMorgan is the key entity that is responsible for this, and so I'm focusing on what is specific, what is now, okay, and what is real. And nothing is more now and real than what JPMorgan is doing, and what they've done is just incredible.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a legendary returning guest, Ted Butler, the founder of ButlerResearch.com and longtime advocate for awareness of what's really going on in the precious metals markets, and one that I've followed since the very beginning, and many have for decades, is here with us again. Ted, thanks for joining us again here.
Thank you, Dunnigan. My pleasure.
We've certainly had you talk to us about some unusual dynamics that have been affecting the Comex market and metals in general on several past visits here. These last month or a few weeks at least have been quite remarkable as far as some news coming out about potential shortages of settlement availability of metals on the Comex in the 100-ounce bars, and needing to perhaps to settle physical trades in London, what that's all about, perhaps rule changes that might be coming around that, and also breakdown of consistency in the spot price between different locations, including Chicago and New York. Could you talk to us about, kind of bring us up to date on what you see happening on the Comex and why that's important for people to be aware of?
Sure. It's a lot to cover, so let me see if I can condense it. First of all, there are a lot of unusual things going on, and with all these things, there is no doubt an investment rush towards gold and silver, and both on a retail basis, and you see that in the premiums on items that that people are familiar with, small bars, coins, etc. And there's also a rush in the wholesale market. The type of in silver that means 1,000-ounce bars, and in gold it means either 100-ounce as is the standard on the Comex, or 400-ounce, which is generally the accepted 400-ounce bars, which are normally the accepted institutional industry standard for gold. So this particular investment rush is impacting prices, perhaps not exactly the way that a lot of people are portraying it. For instance, there's a lot of talk about Comex defaulting, close to defaulting, not enough gold to go around, et cetera. And I'm not in that camp. I'm not in the camp that thinks that Comex certainly has defaulted or is about to. I can prove to be wrong, but the fact is we're in the fourth day of the April, which is a major delivery month, traditional delivery month for Comex gold futures. And we've had phenomenal record, as far as I can tell, number of deliveries made of over 25,000 contracts, which equates to 2.5 million ounces of physical gold that was delivered and sometimes redelivered, so the number might be a little bit inflated, but there was a tremendous amount of gold, more than ever before, delivered on the Comex, and that's taken place. I mean, we have the daily statistics on it. It is notable that in order to make this 2.5 million ounce physical delivery over the last 4 days, approximately that amount of new gold had to come into and be deposited into the Comex warehouses, and there was transfers from one category eligible to registered in order to accommodate and accomplish the delivery. But the fact of the matter is the delivery took place. Money changed hands, metal changed hands. The Comex delivery process is working exactly as intended, and I'm kind of baffled, to tell you the truth, about all the talk about LBMA and the crisis on the Comex and not enough gold to go around and defaulting. I don't know what people are talking about. It's working fine as far as the delivery process is concerned. There are things about the Comex that are downright rotten and crooked, and I'll get into those. But as far as the delivery process, or there being any failure or default in delivering, that's nonsense. It's the numbers, the statistics are available. The stuff is being delivered. What's wrong on the Comex, has always been wrong on the Comex, is that this darn paper trading, this futures contract trading, is so corrupt and distorting to prices that the price is manipulated and artificially set. But at least until this point, all the physical deliveries are being made exactly as called for. And any talk of there being a delivery default or anything is bogus. There is a big demand, and prices should go higher. The reason they haven't gone higher is because of this paper trading. But that can change in a minute. And I think it will. There have been some very dramatic changes in the market structure on the Comex, who's long, who's short, and basically it comes down to the big kahuna, JPMorgan, who was all that matters in terms of what's going to happen in gold and silver. These sons of guns have put themselves in such a perfect position. They pulled out every stop, every trick in the book over the last couple of weeks. They've done it over the last 10 years, but over the last couple of weeks, particularly this past reporting week, they have put themselves in a position like never before. These guys, these dirty, rotten scoundrels at JPMorgan have positioned themselves ideally for a liftoff and explosion in both gold and silver prices, the likes of which I don't think we're quite prepared for. And I think that's the real story. Not so much the delivery, because that's fine, but what's going on underneath behind the scenes, okay, is that JPMorgan has pulled off a scam and positioned themselves so well that it takes my breath away.
There's a question specifically on this topic from Kevin Carter and what comes next here. It says, Ted, I'm a longtime subscriber. Why in the world would the shorts not have extricated themselves from their short position on this recent swan dive in the silver price? And if the current situation mirrors the price run-up from the late 2008-2011, is it possible this run-up will come more quickly, given that JPM is positioned perfectly?
That is an excellent question, and one that I think about often. There's about 8 or 10 big shorts. So JPMorgan is usually in that category, but as I said, they've extricated themselves. They're no longer short in gold or silver, which is kind of rare, very rare on the Comex. But as we speak, as of last Tuesday, when the last Commitment of Traders report came out, and I don't think it's changed in the last few days, They have covered all their shorts in gold and silver. In fact, they're slightly long in silver, but a few thousand contracts, but they might even be slightly long in gold. Why these other big shorts, are still short and left holding the bag, is a legitimate question. My best answer is that just by being short in the first place at this time, in this place, and these circumstances, doesn't make any sense. So I have to think that they're not quite aware of the situation. But in any event, as Kevin pointed out, we did have a big sell-off, and in which JPMorgan bought into aggressively, covering all their shorts. Why didn't the other shorts? I don't know. All I know is that the data coming from the U.S. government, the Commodity Futures Trading Commission, in the form of the Commitment of Traders Report, which comes out weekly, indicates conclusively that they have not covered. So we could spend time speculating about why the shorts are doing something that appears to be, foolhardy, but there can be no argument that they haven't covered, period. And now that the speculators, appear completely sold out, there's not much selling left to go on the Comex from, the technical funds, the managed money traders, and other speculators. And therefore, I don't see any chance in the world that the big shorts who have not covered up until now will have any opportunity of buying back shorts on lower prices. The only alternative they face is to buy back shorts, on higher prices. And when they do that, and I think they will at some point, it's going to serve as a rocket booster, to the price that's going to be going up anyway, and let them buy it. I don't know why they're still so short, to be honest, but I do know they are still short, and that's all that matters.
As far as the actual next near-term trajectories for the price, it sounds like there's, at least midterm, we think there will be some significant upward pressure as continued investment demand outstrips all other factors. But in the very short term, though, people are talking about how metals and miners and everything tends to sell off to some extent during a market crash, which we were certainly seeing in the last few weeks, prior to kind of the Fed stepping in and putting a bottom under things. But if there's a renewed wave, if this was just a pause in a market crash, people are asking what if there may be another short-term leg down. Sue Gibson specifically says, "Hi Ted from Australia. Thank you for the work you've done exposing the criminal manipulation for so many years. Do you think precious metals prices will fall further along with everything else when the market finishes its collapse?"
Good question. I don't think so. I think we're on the cusp of a dramatic move up based on the position, based on JPMorgan. To cut to the chase. Does anybody know what the very near term is going to be in price action? Of course not. So, we're all just guessing a bit. But looking at the makeup of the market structure, the tremendous physical buying that's going on, it's hard for me to see, even though I've witnessed it for the last 35 years, them keeping the price under pressure, selling it off when it shouldn't be sold off. So I can't come out and say, oh no, for sure this is the bottom and we're going to go up from here, even though I feel that. But you have to make certain allowances. But one thing I would point out at part of Sue's question is that what we've gotten used to in the past, where the metals sell off, when the stock markets sell off, and all this kind of stuff. I don't know if that's the right narrative. We've gotten used to it. It has been the right narrative, But I see a tremendous shift. I hate to use the word paradigm shift because that can be overused, but a shift where it never should have been. We never should have followed on the downside. The only reason we did in metals was because the damn thing is manipulated, okay? What I'm suggesting now is that the manipulation is at its end and that JPMorgan has positioned itself. Where I will be wrong, okay, in advance, is if these sons of guns at JPMorgan do decide to short aggressively again on the next rally. I'm saying, logic would say, no, stand aside. You'll make a fortune. They have 25 million ounces of physical gold and 1 billion ounces, okay? 1,000 million ounces of silver, physical, tucked away, okay? Hidden from sight. No one can see it, but it's there. And they stand to make an absolute fortune. In fact, they're way ahead on their gold right now. They're ahead more than $10 billion, okay, on their gold position, since they average a price of around $1,200 on, and do the math, $1,200, the $450 times 25 million, you're going to come out to like $11 billion profit they already have in the bag, okay? If it starts to run from here, as I suspect it will, JPMorgan is going to be printing money forever, profits on gold and silver. So will they go short again is the big question and stop the price. I mean, I've said no in the past, admittedly, and they've come back and gone short. Therefore, they may do it again, but they've never been positioned like they are right now. They have more physical silver and gold than they ever had. They have no short position. I say one of these days they're going to stand aside and just let this thing go, and I can't see any better day than right now. So, we'll see. Again, if I'm wrong, it's because that these crooks went in and shorted again. But one day they're going to step away. I mean, this is not something that's going to last forever. It's lasted a long time, no question. They've done it time and time again. But the one time they don't do it, the prices are going to soar. And boy, if there's been a better time for them to step away from shorting, considering everything that's going on in the world, I don't say they started the damn coronavirus. I'm not suggesting that, but okay, talk about a built-in cover story that couldn't even be dreamed of. Okay, it's there, so you got to play it like it's going to explode. I mean, if it doesn't, if it comes down first, well, so be it. You got to live with it.
Sue Gibson goes on with a follow-on question that I think is on the mind of many personal investors right now, and that is, do you believe that there will be metals available at that time to buy, even though there is very little around now? Should we be trying to purchase whatever we can now? Again, this isn't personalized financial advice. This is just your view of the overall market dynamics and metal dynamics.
Yeah, and I would think, look, if it's better to buy now whatever you can get, okay, assuming, you want to be as reasonable as you can, because if my line of thinking is correct, okay, the price is going to be that much higher later on. I don't know what the availability of metal will be along the way, but if the price is higher, in retrospect, you can look back and say, yeah, it would have been better to buy now. I mean, just on a price basis, what the future availability of metal is going to be is a separate question and is anybody's guess. I'm focusing in on the price. Certainly, if you think the price is going higher later on, then you want to buy today.
We have another question on a different aspect of this from 00RPHB, who asks, Dear Ted, what is thine opinion of this crisis? I believe this money printing Weimar style will short-term be unable to offset the deflationary pressure that will lead to widespread defaults. But within a few years, after this current corona crisis is over, will result in hyperinflation, and that silver at that time will go to the moon. Do you see that as realistic, or are the timing just wrong?
Well, no, I mean, that's the billion-dollar question that's kind of on everybody's mind. I mean, there's no question that, governments, including certainly the U.S. government, the Federal Reserve, is just like, creating money, out of thin air in quantities that are hard to conceive and comprehend. And the same thing is going on, around the world. There's got to be some kind of a consequence. I don't know, what the consequence, how it's going to exactly play out. What he said sounded pretty good, like, we still have this highly deflationary or contracting economy situation right now, which is why the money's being created, by the trillions in order to hold that up. And you think that, geez, there's got to be some kind of effect, some kind of cause and effect, both near term and long term. And it's like when you start thinking about it, your head starts to hurt. You don't know what the thing is how it's going to turn out. What I'm focused on, however, and I share all those things, and I don't know the answer, but I'm looking at the here and now. The here and now, the Comex has always set the price of gold and silver, and anybody that argues with that is arguing with the moon or something, because it's obvious. And JPMorgan is the key entity that is responsible for this. And so I'm focusing on what is specific, what is now, and what is real. And nothing is more now and real than what JPMorgan is doing, and what they've done is just incredible.
We have a related question about the dynamics that are allowed to happen or not allowed to happen on the Comex. Pina Posca says, are there positional limits on long futures contracts on gold, silver at the Comex and no limits on short contracts? And what really happened in the 2010-2011 massive appreciation of gold and silver? Is it physical demand overwhelmed the bullion bank shorts, or did the bullion banks deliberately allow the prices to rise and were long themselves?
That's a good question. Look, no. To answer the question, there's no position limits. The CFTC has been dicking around with this thing for since the last financial crisis. It was one of the hallmarks of the Dodd-Frank Act, which was to put position limits on derivatives, and somehow the regulators has managed to fritter away the time. There are no position limits, and I don't think they're going to be position limits, neither for the long side or the short side. Of course, the federal regulator, the CFTC, and the Comex itself, the CME group, can selectively pick on longs that are driving the market up if they have too big of a position, but that hasn't been the case, and I really wouldn't worry about it too much. Position limits are not a matter now. The question that was asked about what took place in 2000 to 2011, specifically in silver, when we ran up from current prices where we are now, or even lower, to $50 in a relatively short period of time. That was all physical. That was nothing to do with the Comex. The positions on the Comex, the futures positions on the Comex at that time, were basically static. They didn't change. The longs stayed with their positions, the shorts stayed with their positions, and yet the price just run up 2-3 times in price. And the reason was because of physical demand. We had just a surge of investment buying, as we're seeing now. There's tremendous similarities. Buying in silver, particularly in the silver ETFs, SLV specifically, where a lot of people just started to buy because the price was going up, and that created physical demand. When you buy a SLV or GLD, it requires the trust to go out and buy physical metal to match the new shares that are being bought. And that's what drove up the price. And when it got to the $50, then the alchemists at JPMorgan went to work and engineered a tremendous price sell-off that has lasted 9 years till to this day. And but they being JPMorgan, since they were the orchestrator of the price decline, which, by the way, when the price started coming down, everybody stopped buying the ETFs and started selling, and so the physical crunch was over. But in the meantime, in the last 9 years, they couldn't do it in a day or a year. JPMorgan went to work quietly behind the scenes and started buying up every ounce, physical ounce of gold and silver that they could. They've had 9 years to do it, and over those 9 years, they've picked up, I say, 25 million ounces of gold and 1,000 million, a billion ounces of silver, more than anybody, any entity in the world, 10 times what the Hunt brothers bought or Warren Buffett bought in 1998, and that's the story.
We have a question about separation of spot prices between different markets. Kevin W. says, will the continued separation of silver and gold prices on the open market away from the Comex and LBMA make them more irrelevant going forward?
Yes is the answer. In other words, the only price that matters is the Comex price. I mean, I don't even know where they're getting half of this spot prices from. I think they're bad price feeds or something like that. If you want to know the current price, just look at June gold and look at May silver. And when those months come up for delivery, then we'll look at the next rollover months. Don't waste time on anything except looking at, if you want to know the current price, June gold, May silver, for the time being.
Turning our attention to central banks' accumulation of gold, we have two questions in that regards. One is about, do you have any theories or information or insights into why, after aggressive accumulation of physical metals over the past year and a half, since around the time before and following the Basel III reclassification of gold as a Tier 1 asset, a viewer, Rudya Kotwal, asks, "Hi Ted, please detail your views on Russia stopping the purchase of gold." And the second one is, what is the evidence of central banks' gold holdings and who backs them in the event of insolvency? That's from It's All a Lie.
Well, you know what? It's kind of a complicated question. I do see Russia announce that they're stepping away from buying gold. Maybe they feel they have enough. They've been buying a whole bunch over the years at prices lower than they are today. So maybe I don't know, maybe they're getting, I can't read their minds. They're getting set for a run up and they feel that they have enough. As far as why or what the plan is on central banks, I mean, every single one of them seems to have the ability to create money out of thin air. And, if you were in a position that you could create money out of thin air, then you'd have to do something with the money. It's so you're going to buy something. I don't know. I mean, they're going into our government, I guess others, our Fed and other central banks are going in to prop up the various debt markets, mortgages, corporate debt, et cetera, and with all these repos and everything else, with not necessarily the U.S. government. I don't think they're doing it. I think JPMorgan is getting all the physical gold at the expense of the U.S. government, but other governments with all this excess in money and the ability to create purchasing power out of thin air, I guess it's kind of natural. You got to put it into something. Why not gold? It's considered a monetary asset. Silver's not, which is, who cares? It's still going to be in short supply. I don't know what the plans are of the central banks. Generally speaking, however, they're not a factor in the day-to-day determination of the gold price. It's a much, they're not day traders or anything like that. I know a lot of people think, the central banks are the ones that are intervening on the Comex or whatever, and I find that preposterous. These guys are not that smart. They're they're very slow-footed. in my opinion. I think private entities like JPMorgan are a lot more nimble and sophisticated and nefarious than any government counterpart. But I don't think, look, there's no doubt that central banks own gold, a big chunk of it. I don't think they change that much from day to day. What changes is the trading on the Comex. That's where the price change comes from, and the price is basically set. The central banks kind of follow the lead of JPMorgan and others on the Comex, which that's my opinion anyway.
Well, Ted, before we let you go, we have one last wild card from Business Pins who says, what's the one thing we should be talking about and that isn't being discussed?
Oh, great question. I think we've touched on it just a little while ago. It's the only thing that matters as far as I'm concerned, and that's what JPMorgan intends to do. Specifically, do they intend to stand aside, put their hands in their pocket, go on vacation, just turn their back, completely, and choose not to aggressively intervene in the gold and silver market when it starts to go up, and as they always have before, and aggressively add new short positions to slow the rise and eventually cap the price rally. That's the gazillion-dollar question, to which nobody really has an answer, but we're going to get to observe it. If the price does shoot up, and we'll know from public data, always public data, the Commitment of Traders report, whether the crooks at JPMorgan are going short again, and then that's a little bit of a cause for alarm. They might fake us out. They might, sell a little bit to make us think that, oh God, here we come again. They're gonna knock this down again and fake us out. And but that's the key question. It's all that matters. There's a lot of stuff going on in the world with the economy and health matters and everything else, and I don't mean to downplay them, but the most important thing, the thing that we should be thinking about and watching and observing is what JPMorgan does on the next rally. Will they add to short positions, or will they stand aside? We'll partially get the answer from the price action itself, If they're not selling aggressively, the price is going to zoom. However, we'll also get the answer in more substantive form in that it'll be in the Commitment of Traders report. We'll see if they go short because it gets reported. It's a phenomenal report. It's complicated to most people, but it's the empirical data that will show what these crooks at JPMorgan are up to.
Well, Ted, that's great, and I really appreciate the update for our viewers. They hang on your every word as far as the experienced judgment and perspective that you bring that really rounds things out for them and helps us all understand more about what's actually transpiring on these very important markets. And we just appreciate very much your joining us here again on Liberty and Finance and Reluctant Preppers.
Thank you very much for the opportunity, Donegan. You stay well.
You too. If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.